Hey everyone, I'm Val, and today I want to share something I completely overlooked when I started studying ICT. And honestly, I wish I hadn't, because it would have saved me time and a lot of losing trades. I'm talking about how to anticipate what the market is likely to do next. And to do that, we first need to identify where the market is right now. In this video, I'll show you how I do that, how I frame my setups, and how I wait for them instead of chasing price. This is my personal interpretation of what ICT teaches about market conditions, so I recommend watching his original video too. I left the link in the description below. Now let's get into it. The market can only be in one of these four conditions: consolidation, expansion, retracement, or reversal. As ICT says, everything starts with consolidation. In this video, I will focus on just the first two, consolidation and expansion. So, what is consolidation? It's when price trades inside the clear range like this, and we can easily identify the high and the low. Just a quick note here from ICT: when marking the consolidation range on your chart, focus on the bodies of the candles, not the wicks. The bodies give you a clearer reference for the range. When the market is consolidating, it's accumulating orders above the high and below the low. We should also mark in our charts the midpoint of the range, which is the equilibrium level, because it's a key institutional reference point. Alright, here we have a consolidation range. So, what do? Nothing. We wait. Of course, some traders work inside the range, but that's not my style. I wait, because consolidation always leads to one thing: expansion. We just need to wait for a clear sign that price is ready to move away from the range. What is expansion? It's a strong move away from the consolidation range, typically starting with a powerful push from the equilibrium level. Price can expand either to the upside or to the downside. As we see here, price consolidated for a while, then tapped the equilibrium level and expanded in one direction. The key is to identify this moment, because that's when we start thinking about our next setup. We will go over some examples shortly. As soon as we see the expansion, we naturally feel the impulse to jump in the direction of the move. But that's exactly what we don't want to do. We don't chase price. So, what do we do instead? When we identify the expansion, we look for an order block near or at the equilibrium level in the direction of the move. If you're not familiar with order blocks, here's a quick explanation and example. A bullish order block is the last down closed candle or series of down closed candles before a strong move up. A bearish order block is the last up closed candle or series of up closed candles before a sharp move down. If you want to dive deeper into this topic, I left a link in the description below where ICT explains it. For example, if price expands up, we look for a bullish order block at or near the equilibrium, and once price returns to that area, there we buy. If price expands down, we look for a bearish order block instead, at or near the equilibrium level, and when price comes back to this area, there we sell. These would be the setup ideas. Let's see some examples on the charts. Here we see a clear consolidation range. Price moves inside this range for a while. Remember that we mark the range using the bodies of the candles, not the wicks. And also we find the equilibrium level in the middle. After that, price suddenly moves away from the range, and that's the first sign of expansion, or that price wants to move away in that direction. In this example, price expands to the upside, so we look for a bullish order block here, near the equilibrium level. We mark it in our charts and wait for price to come back to this area. That's where we plan our buy setup. In case you missed this entry, you can still join the move on a retracement, like a pullback into a fair value gap, like here. I'm not covering retracements in this video, but just mentioning it for context. Continuing with the same example, here we can frame our setup based on what we discussed before. The entry is at the bullish order block, and we are aiming for the buy-side liquidity resting above in this example. The key here is understanding the entry and the stop-loss placement. When expansion is to the upside, I usually place the stop-loss below the order block or at the low of the consolidation range, since I don't expect price to return to this area. For a more conservative stop, you can give it a bit of room, just in case a wick sweeps lower, but in general, I try to keep the stop tight and aim for 2R or a clear PDRA level above. In this case, the setup delivers a great risk-reward, probably around 5 or 6R. Here we have another example, but in this case, with expansion to the downside, we can see a clear consolidation range. Price moves inside this range for a while, then price suddenly moves away from the range. That's our first sign of expansion. In this example, price expands to the downside, so we look for a bearish order block near the equilibrium level, and we wait for price to come back to this area. That's where we plan our sell setup. In case you miss this entry, you can wait for a retracement into a bearish fair value gap, like in this case, especially if you think price is still going lower. I'm not covering that setup in this video, just mentioning it for reference. Continuing with the same example, here we can frame our setup. This would be our entry point at the retest of the bearish order block. Notice that when price comes back to this area, there's a wick that taps into it. So for a more conservative stop placement, it's safer to place it at the consolidation high level or above the order block, but giving a bit of room to avoid getting stopped out with wicks like this. In case you get stopped out, you can still consider re-entering with the same idea, as long as the structure and bias remain valid. To make a quick recap, start by identifying consolidation ranges, then watch for expansion, either up or down. Once expansion begins, mark the order block near the equilibrium level and backtest how often price returns to that area. That's where you'll often find solid entry opportunities. I recommend backtesting this yourself and journaling the results. I hope this video was insightful and helped you in your trading. If it did, like and subscribe for more. Thanks for watching. See you in the next one.